American bondholders are on edge. Inflation may not be spiraling out of control, but the mere fear of it is rattling markets. Yields are climbing, bond prices are falling, and investors are asking, is the era of low inflation over? In this video, we'll explain why bondholders are so nervous, how inflation eats away at fixed income returns, what signals markets are flashing right now, and what it all means for your money. Let's start with the basics. A bond is essentially an IOU. You lend money to the government or a company, they pay you interest, and eventually they return your principal. But here's the catch. Those interest payments are fixed in dollars. If inflation rises, the value of those payments falls in real terms. In other words, inflation silently robs bondholders. That's why they're watching every inflation number like hawks. So why the anxiety in 2025? Several reasons. Sticky inflation. After falling from pandemic highs, inflation has plateaued above the Fed's 2% target. Even 3% inflation cuts into bond returns, fiscal deficits. The US government is borrowing heavily, issuing more bonds, and investors worry those bonds will lose value if inflation picks up. Policy uncertainty. With political battles over the Federal Reserve and pressure from the White House, investors fear the Fed might cut rates too soon, reigniting price pressures. The result? Yields on long-term treasuries have moved higher, signaling investors are demanding compensation for inflation risk. One way markets measure inflation expectations is through Treasury Inflation-Protected Securities, or TIPS. The gap between TIPS and regular Treasury yields is called the break-even rate. Right now, break-evens suggest investors expect inflation to stay above target for years. That's why you'll hear analysts say, bondholders are jumpy. Even a small surprise in monthly CPI data can trigger big swings in bond prices. This isn't the first time bondholders have worried about inflation. In the 1970s, inflation surged into double digits, and bondholders got crushed as yields spiked and bond prices collapsed. The Fed eventually tamed it, but only with painful rate hikes. More recently, after 2008, bondholders feared money printing would cause inflation. But inflation stayed low for a decade. That history reminds us, markets can overreact in both directions. Still, memories of past inflation shocks linger, and that's what keeps bond investors cautious today. So who feels the impact? Retirees and savers. Many rely on bonds for stable income, and inflation eats into that income. Pension funds. Big funds holding trillions in treasuries see portfolio values drop when yields rise. Municipalities and companies. If investors demand higher yields, borrowing costs climb, hitting local budgets and corporate balance sheets. In short, nervous bondholders don't just affect Wall Street, they affect every part of the economy. The Federal Reserve is caught in the middle. Policymakers want to cut rates to support growth, but too much easing could reignite inflation. Meanwhile, political pressure is mounting, with the White House urging faster cuts to juice the economy. Bondholders worry the Fed might bend, undermining its credibility, and when trust in the Fed wobbles, inflation fears grow stronger. So, what should you keep an eye on? Monthly inflation data, any upside surprise, jolts bonds, Fed meetings. Markets dissect every word of Jerome Powell's press conferences, Treasury auctions. Weak demand signals investors want higher yields to protect against inflation. Together, these events drive whether bondholders calm down or panic further. At its core, the bond market is a battle between inflation and trust. Investors lend money today, betting they'll get fair value tomorrow. When inflation expectations rise, that trust wavers. Bondholders may be jumpy in 2025, but their fears remind us of a timeless truth. In finance, stability is everything. What do you think? Are bond markets overreacting to inflation, or sounding the alarm for what's ahead? Let us know in the comments, and don't forget to subscribe for more deep dives into the forces shaping the global economy.